This is Val Hughes of the Value Guys on the Financial Survival Network. Hello everybody, welcome to another edition of the Value Guys Stock Talk Show with the Value Guys. I'm Val Hughes.
And I'm Momentum.
And we are 31.3-year Wall Street veterans who have had to take on secret identities and go underground in order to provide our candid views on a handful of stocks that we screen for each week here in the shop. You've seen our faces on TV, you've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices, and they'll never know. This week is April 6th, 2012, and this week we've done a small cap value screen that we use here in the shop, and it's a little different this week. It's a return on assets screen sorted on a couple of valuation metrics, and we've picked out 4 pretty good ideas this week. But before we get to that, a couple of important caveats. First, this show's for entertainment purposes only. That's not a guarantee. Secondly, this is a hobby for Mo and I after work, so usually during the week we do a lot of careful fundamental analysis and double check our work. Here we've done none of that. We're just kind of chatting after work. Third, our lawyers say to remind you that this is not necessarily a view that will help your personal net worth, so make sure you do your own work. We might be thinking the opposite of what's right for you. And fourth, we've been drinking, so, you know.
And we're just starting.
Just getting going. It's early in the day. So see all our caveats, photographs, biographies, links to past shows at www.thevalueguys.com. So let's see. In the last month or so, we've been doing some screens that we use here in the shop. You can see all this in our iTunes index or on the site, thevalueguys.com. But we did, I think, a PE screen. Low PE, low price to book, low enterprise value to sales. This week, Mo, we're going to mix it up a little bit.
Right.
We're doing, and this is in Yahoo Finance, it's free. We did a screen just on return on assets.
And debt to capital.
And then a filter on debt to capital. And the idea was I was looking for about 50 stocks that you and I could sort of page through here over drinks. You know, it's a hobby, what can I tell you?
That gives us about 7.4 seconds
per name,
yeah. Which is about right.
What does your wife think you're doing right now? Does she know where you're at?
Yeah.
So she
knows,
does.
yeah.
Okay. I think I told my wife I had
I'm on a business trip.
Work to do in the office.
Yeah.
So anyway, we're just sneaking this in. It's a holiday weekend.
It feels like an addiction.
Does it?
Yeah.
To who? To ourselves?
Yeah.
Well, it's just a way to, I'm doing this anyway, Mo. You know that, right? So we've got a value screen, and we're going to talk about it. I don't know. Did I interrupt you? I've lost my train of thought now.
No. Should we start?
I don't know. We've got a new segment on the show called Paging Through National Economic Trends. Although this week we decided to take a look at paging through national monetary trends because that's where the really scary information is. So, yeah, I mean, we could just get right in it. You know, Mo, you had kind of an interesting idea this week. This came out of the screen.
Yeah, we had a couple. Here's something that we're looking at on our side. We're always looking for interesting deals. What if Portugal, Greece, Spain, and Ireland abandon the euro?
Yeah.
Devalue their currencies.
Okay.
Become huge vacation destinations.
Yeah.
Real estate.
Well, with global warming, it's a no-brainer, right?
Yeah. So, we're looking at real estate in Greece.
Your firm.
We're actually thinking about buying Greece. But
are you syndicating that?
I don't know. We may just buy it ourselves.
Uh-huh. But,
that's the idea. It becomes a big vacation destination. It's not something our listeners can use because we're a financial powerhouse. But
right. Any theme parks planned or anything?
The whole country. The whole country.
Ireland land. That's a double use of land, isn't it? Ireland
land.
Huh. Interesting.
Yep. So that's
what
you guys
sound real busy over there.
Yeah. Yeah. So here's an
now that you're a national bank, I guess things are getting a little easier over there.
It is a lot easier. It's a good business plan. We borrow money at 0% interest. And then we invested in things that go up 20%.
You were talking about.
And we leverage ourselves 90 to 1.
You are supposed to bring, Mo. Last week you were talking about that screen that of just stocks that go up.
Yeah,
I think
well,
you were supposed to bring that in.
Yeah, but it's a
What is it?
proprietary
You
thing.
can't get out of. They don't let you take that out of there.
They
do
do not.
they? They got guards and all that.
Wouldn't
No.
you? It's a
Yeah, no, I would. I'd have
And it
clothes
is-
on too.
It's what differentiates us
Well,
from
we
other.
don't do any of that. We just a couple guys in a little shop here. We
But this
just try to make our way.
This is some interesting stuff we got today.
Well, we actually use these screens in the shop. So here's the point to make. If you're a value guy, you don't just have to screen on valuation metrics, although that was the last couple screens we did. Those were the last couple screens?
We did. We
in
also
English lesson. Anyway, this week it's not a value screen per se. It's a screen for good companies with good returns, but then you can rank that on valuation. It's just another way to get at it. So I thought you had a couple.
We did. We came up with we ranked these today, not totally alphabetically. We ranked them by height.
We did. Height of the CEO.
Yeah. So we're starting.
All right. Well, go ahead. This is your idea this week,
First,
Mo.
Advance America. So these guys are cash advance centers.
Yeah.
Did you know that's legal?
At one time, I'm sure it wasn't, but now it is.
Wow.
Nice.
So
Yeah.
you can lend unsecured to people, lend money to them. They have to pay you back on their next payday, which
Well, it's
says
secured by the paycheck,
right.
presumably, if you believe they have a job.
You know what it works out to about 181% compounded rate of return on that money.
Well, here's the thing about that, because the regulators get on this and the interest rates. Part of their fee is a fee. So it's fixed costs. A person taking your check, looking at it, that may take 20 minutes. That person makes $20 an hour. So that's $6 just of cost.
Right.
But when you're a government official and you turn that $6 into an interest rate and the paycheck is $100,
yeah.
Yeah, I mean
They
they
come
should look
sniffing
into
around. Yeah.
look at ATM fees. My God, every time you take something out, every time you take a couple $100 out, they charge you $4.
Well, here's a way to play that. But these guys have got almost a 26% return on equity. Not bad. And here's another thing. They have for 4 years in a row been paying down their debt. You mentioned that before when we were
Well, that's
talking
an
about
impressive feature here.
I mean, they had $200 million worth of debt. They're now down to $100 million, and that's over 4 years.
Yeah.
So that's probably going to continue to fuel that ROE.
Well, they're generating a ton of operating cash. I hadn't looked at this in a while, and it popped up on this screen. A lot of times value guys are looking at the dregs, stuff that's looking terrible, and so you don't often see good companies that have been good last year, where you do a ROA screen, and these guys are doing well right now. But here's the question: why then? And this is, you reverse it around. When you look at a cheap stock, what's good about it? When you look at a good company, why is it cheap? That's what you got to.
Well, there's only two people that follow the company, so that's not a complete explanation.
It's
but
5 times EBITDA. So here it is. It's a good return.
Yeah.
Okay, we screened on that. 5 times EBITDA.
Why? Do you know they also have about a 2.5% yield? So there is even a little yield there.
Yeah. Well, they're throwing off a ton of cash. And
well, it's interesting. The sales have been inching up. I wouldn't say they're gangbusters, but I would want to see the receivables. Or just in an economy, I'd just like to see if they're managing their receivables is probably a big part of this. Although, if you're right, if it is secured by your paycheck, then you don't have that issue.
Well, you might. I mean, I guess people get fired and all that.
Yeah.
And you see the stock here. So here it's at 1046.
Yeah.
We're recommending it. Even you, Mo, recommending this. It's a value. But look, the chart. This thing was at $1.
Yeah.
In 2008, anything with a lot of leverage was beat up. And if you look at the leverage here, that's what's really changed in this company, right? I mean,
200
in
million
08 they
down
were 100% debt to equity.
Yeah.
Now they're 40. So that's a nice thing.
Yeah. So it's it's a small cap, 650 million. It's got a little yield. Doesn't look like it's over discovered. Decent business model. I think even if the economy recovers, this is a sort of a niche group that uses these kind of services when the economy's good and when the economy's bad. So yeah, it's an interesting name.
I agree with you.
All right.
I mean, there's a big cash only economy in America, and these guys are going to get in on that. They're kind of the bank for someone who doesn't have a bank.
Yeah. So what'd you
All
come up
right.
with?
Well, okay, that was a good one. I've got something here. Again, this screen, when you run these screens, I mean, the idea is you get an inbox and you go through them. So Mo and I went through about 50 names today. And again, my kids want to play basketball, but I'm doing this. Why? Dedication.
Right.
That dedication, that's what it takes.
You don't like basketball.
Also that. And it's a little chilly out. We got used to that warm weather. What happened? Anyway. Adtran, ticker ADTN. This came up through this screen. It was a screen 15% return on assets or greater, and so 15 would be the minimum. And then a screen debt to equity of 1.5 or less, and then under 2 billion, which is always a small cap value threshold. And so you get a different set of names than you might when you do just a pure valuation screen. Adtran, return on assets, let's see here. It's been trending in the upper teens. Last year, 18. Forecast this year at 13. Return on equity is a little higher in the 20s. Their debt to cap, in the upper single digits. So all that, those sort of, is the oil right? Does the steering wheel work? Yeah. Gross margins, upper 50s. Now that's going to catch my attention, ladies and gentlemen. Who earns that kind of margin? And what I like to do, when someone earns a 60% gross margin, I like to do the inverse. So if 60% is what I get to keep, and I charge 100, I like to do the math, 100 divided by 60%. So what's that? I don't have a calculator, but it's like an 80% markup on your cost. Why would anyone pay that? It must be because they're doing something that you don't know how to do. And when you start to have, $700 million worth of sales in something other people don't know how to do, I think that's a pretty interesting business.
Well, can I interrupt you for a second?
Please.
What these guys do, when you think about it, is they're a basic telecom company, right? They create networks for people. And so the good thing about them is they're not tied to any technology,
right,
or any product.
Yep.
They have two divisions. One, they work for the phone company, doing the networks for the phone companies, and then they'll do companies, like they might do the campus at the Apple. When you got those customers, they're sticky.
Yeah, why would they turn that off if it works? They won't.
And plus, even if it doesn't work that well, it's so tumultuous to rip out a whole data networking system. So they got sticky customers.
Yeah.
They obviously have got a proprietary edge on the competition, and I think that explains why the margins are so high.
I completely agree with that. I think that when you have exit barriers for the user, that's a good time.
Yeah.
It's kind of, you sort of have a monopoly. They bring a 25% to the EBITDA margin, 23%, 27 last year, percent EBIT margin. And again, you want to look at something of all costs, the markup. So again, if I have a 22% EBIT margin, that's before interest and taxes, but just on a pure business earnings, that's a markup. So I've got so it's 100 in sales, 78% in total cost, just to round it. So what's 100 over 78? Again, I don't have a calculator here. That's about 25% or something like that. Markup on total cost. Why do people pay that? Because they can't do it themselves. You've got something proprietary when you're seeing margins that high. But then when you do a screen like this, the question is, why is it cheap? Because we already know it's got a good return. We've screened on that. And in this case, here's the answer, Mo. They keep missing estimates. So, they had a period 6 months ago, and I'm looking at FactSet data here that track earnings estimates. But, I think Yahoo Finance does the same thing. There's a couple other sites. You can find a lot of this out there. But this particular company, about 6 months ago, all the analysts dropped their estimates a lot, which just means they missed a number, they disappointed, they thought they could earn one margin or get one sales level, and they didn't. And so the street is wary. So they've been missing a lot of numbers, and I think that probably explains the discount, but I'm willing to take that risk, I think, because otherwise it looks pretty good. So
Yeah.
whatever.
Yeah.
Okay, next up, you've got one that looks pretty good over here. I'm a customer, actually.
Skull candy.
Customer.
This
Yeah.
is not, this isn't something that's being marketed to like cannibals. It's not
Yeah.
a food. It's not a food stuff.
No.
It's
No,
actually,
it isn't.
No, it's actually.
But everyone knows what it is that's listening, probably. Our
Yeah.
parents don't,
You're right.
you know.
You're right. Skull candy.
Skull candy.
Anyway, earbuds.
Earbuds.
And not cheap
Yeah.
ones either. They're like $30 earbuds. Ticker symbol is SKUL. Yeah, they interestingly enough, they've been around since 2003. That's when they were formed. So it took them 4 years before they came public. They did their IPO, and then they did their IPO. They were positive net income. Look at this. These guys
Yeah.
actually produced, for this tiny of a company, they got 500 million market cap, and they've
Yeah.
actually got pretty nice net
Well, they
income.
had nearly a 20% net margin in their first year of being public. It's pretty impressive.
Yeah. There's not a lot of CapEx to maintain this thing and to continue to grow it. Now, I'm thinking I own an iPod, an iTouch, an iPad, and an iPhone. And I use the audio on, I've used the earbuds on every one of these pieces.
Yeah.
So you have a proliferation of gadgets you're going to want to
Yeah.
listen to. These are headphones that you wear out, you lose. So you're in a business that's not going to go away anytime soon.
Well, my
So-
experience with these things, normally I'd say, well, look, we just did it. I looked online, okay? Obviously, there's thousands of these things. But people can only name a few brands, and this is one of the ones people name. And so they're doing something right in the sort of advertising promotion area. And also I think they're doing something right in the quality area because they're getting some press. But my own experience was when we first were getting buds, I went out and, I have some nice speakers, right?
Mhm.
You have
Yep.
speakers. I said,
Yep.
I'm going to go out and I bought some Shure buds.
The $100
Early on,
ones?
these were $600. $600. And I said, I'm only going to buy these ones. I have speakers I've had for 20 years. I'm going to buy these earbuds. They're going to be the frickin' best, and that'll take care of that, right? Guess
And
what? 2 weeks later, what? Lost, right? So then I'm like, woo,
Ooh.
wow, ouch. I can't be doing that every other day. So I said, I'm not going to get those Shures. Those are too expensive. I'm going to buy these clips, or clips. How do you say that?
Yeah, clips.
Clips. And those are awfully darn good, too. And those were $200. They're not quite as good as the Shures, but, I'm not going to spend that kind of money.
And for any listeners that have even the vaguest doubt that that Val is part of the upper half of the 1%, just needs to listen to what his annual earbud allocation is.
These are one-time. This isn't consumption. I'm pretty good on consumption. I thought these were actually asset acquisitions that I'd have for 20 years, like my speakers or my phone. I barely ever get a new phone. So I bought the clips, $200. I was really enjoying the heck out of them, and then 3 days later, I lost them again on a freaking plane. Okay, so I'm at the plane. I'm at the store. I'm like, I need some buds. What's dangling all in front of me, all over? I can't even see the guy.
Skull candy.
Skull candy.
Yeah. Great
So,
color. What color did you get?
I ended up getting like a lime green. I didn't want them, but that's what they had. I was a little, you see a guy like me walking with, lime green earbuds.
Yeah, you look
It's a little
like Kermit
unusual.
the Frog.
But what have you, you see people wearing all kinds of crazy stuff on their heads nowadays. But the thing I note about this company is that they are ubiquitous now in terms of where you can buy these earbuds, and you're losing them all the time, and they've got them priced at a point where they really are like candy. You get them, you use it up,
How did they sound?
and then they're fine. I can't tell the difference, frankly, between these earbuds and those clips earbuds that were, really 10 times the price. So
Wow.
I'm impressed with them as a customer, but I hadn't looked at the stock before, Mo, until you
Well,
brought it up here.
That's That's my thinking there. I do like them paying down debt. The stock's had a couple of ups and downs recently, but this is not a brand new company. You might think they just burst on the scene, but they're a seasoned company, real business. We like the valuation. That's that.
I'd also add a couple things, which is in a market where you might think there's a lot of commodities, and there's 50 of these brands. If you go type in earbud into Google, so why these? Well, the reason I think they really might be onto something is, first, it's ubiquitous in terms of placement. So that's not easy to do, and they've done it, and they're not going to get displaced anytime soon because they're kind of on it, like a Skechers or something in shoes, or a Coach, or somebody that just keeps refreshing. They're putting up 20% EBITDA margins in a commodity business from a functional point of view. How are they earning that? It's because people want that. They want the brand. They're quite likely managing the turnover for all these little retailers, and the little retailers like it because they're getting extra money from it. They're putting up an 11% net margin in the commodity business. So I'm just inferring, and again, my own experience, that they're doing a lot of stuff right on that whole vendor turnover distribution market and on the promotion market, and you're paying 10 times EBITDA, so and you still have penetration rates rising for earbuds per person, mobile music per person, all that's
Right.
going the right way too. So I thought I wouldn't like this, Mo, but I ended up.
Well, there's one other thing which I look at sometimes. You notice that there are 8 analysts that are following the company.
Yeah.
It's only a 500 million market cap company, so that's crazy. You only have that for 2 reasons. One, the company's about to do an IPO, and all the analysts are picking up coverage of the company because the bankers need coverage in order to pitch.
They're competing for the next
the
deal
deal
or whatever.
Or
Or
it's a great story. Every analyst that follows big, boring, large caps loves a little skull candy in his back pocket that he can pull out at the end of a client meeting and say, hey, and here's a little one.
Here's something your daughter and you can talk about.
Here's a fun one.
Yeah.
So, that's a possibility. That may confirm our belief that it's a good story, that, it's now become the pocket candy, skull candy.
Well, and it's profitable and it's not too expensive.
Yeah.
I like that.
Yeah.
Okay, one last one here, ladies and gentlemen. Again, this all comes off this ROA, return on asset screen that we did in Yahoo Finance for free. So check that out. It's in their investing area. You got to drill in there, but investing, stocks, stock screener. I think you click that and you're in. Here's one called High Tech Pharmacol. I think Pharmacal. HITK is the ticker, and this is headquartered up in Amityville, New York.
Made famous by the movie.
Yeah.
Horror this was not the horror of Amityville.
No.
I don't think it was.
This was The Cure. This was The Cure.
It was The Cure, you're
the
right.
pharmaceutical.
Yes, you're
Yeah.
right.
What these guys do is they're a pharmaceutical company. They develop, manufacture, and market generic, prescription, and over-the-counter products. I'm just reading out of the 10K.
But generic drugs, tell me that's not growing business in the aging population.
Well, it's certainly, actually the share there is smoothing out. Generics now have well over half of any category where they can have, and all the big drugs, particularly things like Lipitor, are about to go. So you're right. The bulk of drugs, everybody was worried about the cost of pharmaceuticals, but increasingly the stuff people use every day is off patent and pretty cheap. And the scientists aren't actually inventing that much new stuff. We're about to have a whole shift in research from, trial and error to, human genome directed pharma research. So people alive now, it's going to be pretty fun to watch. If you're dead, you won't benefit from that.
We'll be watching anyway, though.
Yeah, we will. We'll be watching. So, generics are, clearly the drug of choice. And these guys' claims here, they specialize, Mo, in difficult to manufacture liquid and semi-solid dosage forms. And then in addition, as if that's not enough, they offer a wide range of sterile ophthalmic, okay,
Yeah.
and inhalation products.
So that's
Wow.
in your eyes and in your
Yeah,
throat.
and so that sounds good. How's their growth? Their growth rate has been sort of
flowing.
Well, no, it's good. Look, 20% kind of numbers for a long time.
Sales.
Sales.
Right.
EBITDA even higher than that, in the 30% range. They're doing $230 million in sales this year. They did $100 million 6 years ago. They're on a nice clip. They grow every year. They've got EBIT margins in the high 20s, low 30s. EBITDA margins in the 30s. I mean, what's not to like? Return on assets, we already know it's good because we screened on that. They've got a consistent 5 years over 15%. They don't use any leverage or very little, so their ROE is only a couple points higher than ROA. But they could easily double that if they wanted to, because they have no debt. So they could take on debt if they cared to. The valuation here is suspicious, ladies and gentlemen, to me. It's 4 times EBITDA. It's 9 times earnings. Now, why would a company like this sell so cheap? I don't know. It could be that something that's important to their margin that is not a generic drug, but rather is a proprietary drug, is about to go off patent, and their margin on that particular drug is about to go from 70% to 15%.
And you've already seen a little bit of a drop in the EBITDA margins
Yeah.
from 34 to 31.
And then last year, the sales growth also slowed incrementally. So growth rate is one thing.
But it's interesting because you were mentioning, I'm looking down at these statistics too, and if you look at the actual sales they have on this part of the sheet, they've gone from 50% growth, which was their huge year in 2009, but then a 16% growth rate, a 19% growth rate, both good years in 2010 and 11. But then for 2012, 3.7%.
Yeah, right.
So you're seeing a slowdown, you're seeing some contraction in margins. At least you'd want to kick the tires a bit and know
Yeah.
before you jump in the deep end.
Well, what that smells like to me is a particular very high margin product
That's going away.
That's going away, and
Yeah.
it started going away last year, and it's going to continue going away.
Wonder if there's a generic drug to cure that. Bring it back somehow.
Well, yeah, you do some. The drug you can take in our business to cure that, we do take.
Yeah, that's true.
Every week here on the show. So, I will say that to the extent that things are drifting south, they are not surprising anybody. So when you look at analyst estimates, and they've got 5 analysts covering this, I'm reading that. So there's enough to, be aware. And the estimates are not coming down, which means that management is properly, explaining this slowdown.
Yeah.
And so the valuation, in my opinion, already reflects the view that they're going to lose this product. It's going to go off patent. And again, we're just surmising here. But this is certainly worth a look because the market is growing from a sheer, is pharmaceutical gaining share in GDP? Yes, it is. So you've got that wind at your back. Even if they revert their margins out a little bit here, when you're in the 30s on EBITDA margin, you have a lot of room. And when you're at a 4 times EBITDA multiple, you have a lot of room. In other words, their sales could fall in half, their earnings could fall in half. It would be at 8 times EBITDA, roughly, and they might be growing at 15% from that point, just on the basics of unit growth times, times price. And it would still be a good deal. So I think this is worth a little bit of digging in here, Mo.
And that if you look down here on that one of the things that's interesting that FactSet provides is the top holders, and their second biggest holder is James Golden of the Rainbow Fund. Now,
Yeah.
if you were a guy named Golden, would you start something called the Rainbow Fund?
Is gold in the rainbow?
I don't think it is in the rainbow. So
but
you
the
have
pot
gold,
of gold is at the end
of the rainbow. There you go.
That
Well, that
makes
might be
sense.
it. Yeah.
I don't know, Mr. Gold.
I wonder is he the pot of gold at the end of the Rainbow Fund?
I don't know, but let's.
But
hope
he
he's right
obviously
about
likes
this one.
high tech. Yeah.
And then Royce is a big holder here.
Yeah.
As well. So I'd check that out.
Smart money.
High Tech Pharmacol, ticker HITK. Okay. Now,
we
what are
forgot.
doing now, Mo?
To do the paging through.
Yeah, we're going to do paging through. So hold on. I'm going to go off to the copy machine. Just going to pause the show here. Hold on, everybody. Okay, everybody, we're back. This is that exciting part of the show I like to call paging through national economic trends. Except this week, we're going to do paging through national monetary trends. Now, this is a document from the Federal Reserve Bank of St. Louis. If you type National Federal Reserve of St. Louis, what did I say? If you type Federal Reserve Bank of St. Louis into Google, monetary trends, this is going to pop out. And it's got a lot of information in here that, frankly, I don't completely understand. I'm just going to be upfront with that.
I'll tell you what. I just looked at the opening remarks here, and it's a good thing that these are pictures we're looking at, because this Fed funds rate target inflation formula.
Why don't you read that? Yeah.
It has 14 separate components.
There's pi.
F to the t equals 2.5 times pi to the sub t minus 1 plus pi to the sub t minus 1 minus pi asterisk divided by 2 plus. There's more pi in there than we have at Thanksgiving time.
That's a calculus.
That's a pie shop.
It's a pie shop.
Anyway, so it's a good thing we're looking at pictures and not
this is why I don't often go into this. I mean, who knows? Anyway, so my method, which is not all that sophisticated, really.
You do every other one.
But is to go through and look for pictures that seem disturbing.
Disturbing?
Yeah, disturbing.
Can I show you a disturbing picture?
Yeah, that's what we do on this part of the show.
This is page 11.
All right. You turn over to that. Page 11. Paging through national monetary trends. I like saying that. I don't know why. Anyway,
so here's a three-dimensional chart.
Three-dimensional chart. You can't get any more dimensional than that.
Up and down is percent, across is time, and depth is so. But the thing is, if you stare at this long enough, you don't know if that line is coming out at you or whether it's going into the. Look at it.
I see a picture of George Washington when I look at
that. No,
it's
actually a woman taking a shower.
Oh, is it?
But when it's a three-dimensional, you just.
Wait a minute. It might be Alexander Hamilton.
It could be the corner of a room with cracks on the wall.
It could be. What is this trying to say, Mo? This is
too much is what it's trying to say, because my brain can't take it all in.
Inflation-indexed Treasury yield spreads. Okay, well, it's great that it's three dimensions, but I can't really.
But you really need to look at this with your Game Boy.
Yeah,
because then you can really see where everything is.
All right. Well, that's a nice chart, Mo. I'm glad you mentioned that. Here, I have one also. This is on page 5, so we'll have to step back a little bit. And it's called, and it's right at the top, adjusted monetary base, percent change from a year ago. And I remember this scared the crap out of me a couple years ago. It's nice to revisit. So I've got 30 years of data here, and that line is mostly zero, going back for a lot of years. And then in the third quarter of 08, it goes from 0 to 120, just like you're hitting the gas on that. It stays at 120 for about 2 years, comes back, touches 0, and is now sitting around 20, the adjusted monetary base. So,
and what does that mean?
Well, I think what happened is the adjusted monetary base
went up, and then it went down.
Went up a lot. Well, no, it didn't go down. It went up, and then the percent change went down towards 0, but it never went negative. So it doubled in size. And now, I mean, this is basically, I think, the Fed trying to get the economy going by just pushing money out there to hope people will spend it. But instead what they do is they don't spend it. They put it in the bank or something or bury it.
Create another bubble.
Because GDP is flattish while the monetary base is doubling. That means velocity, or the amount of time that the monetary base turns over each year, is going in half. Yeah, so it's, that whole pushing on a string thing a little bit is what's happening there. The other thing I wanted to note, page 5, again, they have something here called small denomination time deposits. And this number back in 09 went negative to nearly negative 20%. And I think what that is bank CDs. And this money is coming out. Now, my question is where's it going? Are people having to, they're getting such a low rate on their saving and their money market funds. Maybe they're having to.
It's going into the monetary base
to buy food. I hope not. And then what else did I have here? The one other thing I would note. On page 7, they have a chart here called Net Percentage of Domestic Banks Tightening Standards for Consumer Loans. That's kind of a lengthy title.
Yes.
But it's turned negative about 3 years ago.
And just to put that in perspective, same 35 years of data, it's never really been negative for more than a nanosecond in 35 years.
But what happened was, so a couple years ago when things were getting bad in terms of defaults, banks tightened their consumer standards, and they raised them by 60%, or 60% of the banks were raising them. Now we've got, we've got about, I don't know, maybe 20% of the banks
are actually easing.
Dropping them now.
Now the thing is, though, are they easing to a very productive level for the economy, or are they just easing because they were so crazy?
That's what I think.
2 years ago,
they just got too tight.
Yeah,
we're just kind of,
going
and that's
back
good
to
for
normal.
the economy, though. Things are kind of healing and mending, and,
right.
and things are working their way out. So that is that's our section, paging through national economic trends, where we actually use monetary trends this week.
And if anyone can read the first introductory remarks and explain some of these formulas to us, email us.
All right, everybody. Well, you've managed to spend another 45 minutes listening to the Value Guys. We appreciate it. See all our caveats, pictures, bios, indices to past shows, best ideas lists, and all that at www.thevalueguys.com. Thanks for listening in, everybody. So long.